If you've looked at your 401k lately and you found that your stomach was dropping, you're not alone. When you're pulling money out of a portfolio that's falling at the same time, the math is just going to work against you in a way most people don't understand until it's too late. It's called sequence of returns risk, and it's the single biggest reason that retirees run out of money. Today, we're going to show you exactly how this works with real dollars and what you can do this week to protect yourself without making the panic moves that make everything else even worse.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
This is Leibel on Fire, and Leibel, hello and welcome back.
Hey, how are you doing today?
Unbelievable. I mean, the setup kind of scared the heck out of me, but maybe we can get calmed down just a little bit. How about, I love these scenarios and the way you respond to them. What happens if I've got a 401k Leibel and it's down 7% since January? So far, so good?
So far, so good. Following you.
Okay. Now, if I keep hearing about sequencing of returns risk, but nobody really explains it fully. What is it? Why does it hit retirees so much harder than somebody who's still working? Can you help me?
Yeah, so let's talk about sequence of return risk, and I'm gonna share the analogy that I share actually with everyone who goes through our free retirement tax file analysis, and it's one that I think is so vitally important, right? When I look at the decisions that we got to make in retirement, the lens that I look at them through is through this lens, right? We've got 5 major risks in retirement, and the number one risk that I tell people about, number one, is what we call drawdown, right? And that's anything that decreases our portfolio value, whether that is market losses, whether that's overpaying on taxes, whether that's paying retail, right? Anything that decreases that finite resource that we have to live on, that is our biggest threat in retirement. And the reason why it is the biggest threat in retirement is because of this thing called sequence risk, right? During our working years, right, the market goes up, the market goes down. It doesn't really matter. In fact, it helps us, right? Because we're saving money in our retirement accounts. We're constantly putting away. We're putting that $100, $200, $500,000, whatever it is, from our paycheck into our retirement savings. And what effectively happens is we're buying, when the market's down, we're buying when the market's up, but we get the benefit of this thing called dollar cost averaging, right? Which means on average, we're buying the market, right, at a lower price than what it is, right? Because we got, sometimes it's negative, sometimes it's positive. What that means is it accelerates our wealth creation. Again, one of the things that makes America so great is that we have some very smart people, or we had some very smart people in government. And every now and then we have some of these geniuses who really work well to create a system that funnels money into the right places and sets up Americans for success for the most part. One of them is this retirement savings, right? Encouraging retirement savings, encouraging the 401ks and the retirement plans to invest them and offer investment options that accelerate that wealth creation process, right? Rather than just taking the money like what happens in some of these third world countries is, the retirement, or not even third world, even first world, right? Like you look at the European retirement systems and it's like, well, you got to put the money into this government run plan and you got 3 investment options and they're all terrible, right? And they're, run by an investment committee of, scared little kitty cats. Anyways, so you say we have this, this compounding growth that's happening in our retirement accounts. And so let's say you have 2 investors, right? They both, start out in the same place, right? And then one has all the great years of the market up front. One has all the bad years of the market up front. Well, guess what? If they both work the same 20 years, putting away the same $20, same amount of money in their retirement savings, and then 20 years, on average, they're going to have the same amount of money because that's how averages work, right? It doesn't matter when you have the positive or the negative. As long as the average is the same, you get that same average outcome. And that is what leads to wealth creation. The problem is in retirement, when we're taking that money out of our accounts, right? It's the losses compound, right? The analogy I like to give people is like riding a bicycle downhill, right? The faster we go and the steeper the hill is, the faster we pedal, right? The faster we go. And if we don't start pumping the brakes, we'll end up splat at the bottom of the hill. And there's a great chart you can find on our website, right, where we show this. You attend our webinars. I show this. You could come to our free retirement tax law analysis that we'll do for you. I'm going to show you this chart. Same two investors starting with the same two amounts. The only difference is now we're taking money out of our portfolio to live off of. Even a modest amount from that portfolio, what happens is the person who has positive years and they're taking that money out, it's great. Market's up. I'm taking money off. I'm only harvesting a small portion of the growth. My money keeps growing, right? And I still have that compounding growth. The person who takes it out when the market is down, right? Their portfolio, let's say their $1 million portfolio, we have a 10% loss. Now it's $900,000. That $900,000 and you take out another $50,000 to live off of, well, now it's $850,000. Market recovers, right? Well, everyone gets their money back during your working years. Okay, you're back to even. Well, in retirement, you still have to make up for that $50,000 loss. And so now your growth is on $150,000 less instead of just $50,000 less, right? And all of a sudden, this starts a cycle, right? As you start having the spiral effect of one after the other. Add inflation in there, and before you know it, maybe your retirement savings aren't empty, but your buying power sure is gone. And now you're wondering, right, how do I pay the bills? And so the sequence of return, the succinct version of it is the risk of compounding your losses by taking money out when the market is down, right? The sequence, the order of your returns matters more in retirement than what your average return is.
That's interesting. So let me see if I can help to sequence it, because I think I've got the answer. So putting numbers on it again, you started with $1 million. I'm going to start with $800,000. So I'm pulling out $4,000 a month against this $800,000 during a downturn.
Yeah.
So how much does that permanently shrink my nest egg compared to that same drop without taking any money out?
Yeah. So in that example that you gave there, right, every single month you're decreasing your portfolio value permanently by 0.5%, but that's compounding. So now that's a negative compounding. So now you've negatively compounded your portfolio by 6% a year, right? Mm-hmm. On top of the loss that you had, right? So not only are you fighting, the market, let's say the market is down for the year for 10%, you have your negative 6%. And then next year, what are you doing, right? You're still taking your 6% out. And so you're fighting it, right? So now every single year, right, instead of having 10% growth on your portfolio, you're having a negative 6% growth, or you're having a 4% growth. And we all know, well, inflation, 4%, now you're at 0. And so every single year that this happens where you're taking out where it's negative, right, you went from treading water or slowly accumulating to going backwards. Right. And this is why it's so important to have that bucketing strategy or to have any strategy that ensures that you don't have to sell when the market is down. And listen, we don't only just use bucketing approaches for how we solve this problem, because you can't just have one solution. Right. It's like, yeah, you can just throw an annuity at a solution like this, but guess what? Then inflation comes and catches up to you. Right. So you got to have multiple layers of defense.
So what do you do when you just said don't sell into a dip?
Yeah.
But if you need money to live on, that $4,000, $3,000, whatever it's going to be, where are you supposed to pull the money from if you don't pull it from your portfolio?
So I'm going to take you back to when you were a kid and everyone said have an emergency fund, right? You remember that? Have an emergency fund. Well, you grew up and you got your millions in your retirement account and you're collecting Social Security. And you kind of forgot about the need for an emergency fund because you were earning such good money and you had credit cards and everyone was throwing money at you because you had earning potential and they wanted a piece of your pie. Guess what? In retirement, all that disappears because now your pie is finite. And they're like, well, we don't want to throw money at you. We want to get your money, but we don't want to give you money because you are a bad loan risk, right? You are someone who we know is going to die in the future. We know your earning potential is negative, right? And we need to figure out, and we want to get at this wealth that you've accumulated, right? So they're going to do everything to work against you. And so really the answer becomes, right, you need to make sure that you have that plan in place. You need to be your own emergency fund, right? And you need to know, okay, this is what we're going to sell first. We have investments. So when the market goes down, it's not going down with them. Or if it's going down with them, it's going down at a smaller percentage than proportion than what the overall market is doing, right? And that is critically important because otherwise you risk compounding those losses. You need to make sure that you have it's not just about being diversified, it's about making sure that you have a plan for where that income is coming from, and that is diversified.
Interesting. Before we get to the end here, I want to ask this quickly. How do you know if there is a correction that recovers in 6 months or the start of something that's even worse? And does it matter how I should react to it?
So we really never know this ahead of time, right? We don't know what's going to trigger a recession, what's going to trigger a market correction. We can have hypotheses. We can be right 50, 70, 80% of the time. But I can guarantee you that every person who is right most of the time is wrong some of the time, right? Nobody is right 100% of the time. And if they are right 100% of the time, it's they got some strings that they can pull that no one else has, or a time machine. And so really the question becomes, right, you make moves based on expectations, but you really need to be looking long term, right? Statistically, what happens if I'm wrong, right? What is my plan if I'm right or I'm wrong, right? We have a plan for our expectations for what the market will do, but what if we're wrong? Because a lot of what the market is, a lot of what the economy is, it's a self-fulfilling prophecy, right? It is the ultimate con ever pulled, was that we created an economic system that is based on our expectation that the future is going to be better than the past, and that that really is it. Bottom line, right? It's that the future is going to be better than the past, and that we're borrowing from that future. We've created it's an infinite Ponzi scheme if we can pull it off. But the day that everyone decides that the future is worse than the past, that is the day that this whole system collapsed, right? That's what brought the Soviet Union down. That's what brings down communism, right? And the only reason why those governments and those systems collapse is because they didn't invest in their future in a sustainable way, right? They didn't invest in it and create something that was better than the past, right? The future actually was worse than the past. And as soon as that happened, for a long enough period of time, it all collapsed. And one day it might happen with us, right? I mean, it happened to the Roman Empire. It's happened to every civilization over time. Eventually things collapse. Are we living in it? I don't know. It took the Romans 400 years to figure out that the Roman Empire collapsed, right? So.
Well, we're 250 years in. Final question for you. So to stop the bleeding without blowing up the long-term plan, what is something that we can do this week, we can do this month to take care and make sure that we're in good shape, or as best the shape we can be in?
Yeah. So the thing is you got to know where your finances are today and the future. You need to have a plan of what is it that you're going to live off of. If you've got that bill, that $50,000 bill, or just whatever makes you go, I need money and I don't have time to figure out where it's coming from. What is your plan? And then you got to figure out the plan. Okay, what happens if the market's down for a year, 2 years, 3 years, 5 years? Because it has happened before, right? What is your plan? And how are you going to make sure that if the market remains down for 5 years, that taking money out and executing that plan isn't going to be a catastrophic failure for your long-term financial security? If you don't have that plan, then you better get one, and we will give it to you for free. We will more than happy to give you our second opinion and give you what we think you should do. And I have had that conversation with people where I tell them, listen, you're living too large, right? You can't afford this, or you got to get really aggressive with your investments and start doing doing things that are non-traditional, because you need asymmetric returns, as we call it.
Welcome to reality. And if you like more information, as Leibel has been suggesting all day today, is go to yields4u.com. Yields, the number 4, the letter u.com. So we do know that a 7% drop in your retirement is not, a 7% drop is not the end of the world for you, but selling stocks to cover monthly expenses while they're down locks in those losses permanently. Build a 6 to 12 month cash buffer in money markets, short-term treasuries, or a CD ladder so you never have to sell equities in a downturn. The retirees who survive market drops aren't the ones who got lucky with the timing. We've learned that today. They're the ones who had a plan for exactly that moment. This is Leibel on Fire. I'm Freddie Bell. He's Leibel Sternbach, and we'll see you next time with Leibel on Fire.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yields4u.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.